Yes, in this video we are going to learn about the physiology behind the penny bar candle formation and how to trade it with a market trend, especially when it forms in the market. In our previous video, we got to understand how to identify a penny bar when it forms in a market, and here we are going to learn the physiology behind its formation. The physiology, I mean the indication, what does it represent when it forms. That's the meaning of physiology behind the penny bar candle formation. So, and here we can see that penny bars are formed when prices are rejected, and this rejection does not indicate a reversal signal, because the price action setup can form everywhere in the chart. I think you can observe this in your daily charts, the weekly charts, and the most important areas where you can watch when trading the penny bars at the major key levels, or what we call the support and resistance levels. Of course, the penny bars form when the prices are rejected, and our rejection points or the turning points are what we call the support and resistance levels. Since penny bars represent prices, therefore when a penny bar forms in a downward trend, that penny bar becomes a bullish penny bar, calling for a buy signal. And when it forms in an uptrend, it becomes a bearish penny bar, calling for a sell signal. So at the support and resistance levels are the major points where prices are rejected. The most important areas to watch when trading the penny bars are the support and resistance levels, the supply and the demand zones, and the moving averages. The formation of a penny bar candlestick chart pattern in these levels give a clear idea about what is going to happen in the market. Of course, when a penny bar forms in a downward trend, it is a clear indication for buyers to start buying the market, because when it forms in a downward trend, automatically it becomes a bullish penny bar, calling for a buy signal. So when a penny bar forms, as a buyer straight, you get to know what is going to happen in the market, depending on where it has formed, either in a downward trend or in an uptrend. And it forms after hitting a resistance level or a support level. Of course, a support level is found in the downward trend, and resistance level is found in an uptrend, depending on your weekly, daily analysis, or what we call the top and down analysis that you have formed on your chart for a particular week. And if the rejection is near a support level, for example, it is an obvious indication that the bulls are more powerful. I have already explained this, that if the rejection is near the support level in the downward trend, it is an obvious indication that the bulls are the buyers that are more powerful, and they are going or willing to push the market to go upwards. And this is illustrated in the chart that you are seeing. This is an illustration. So we have our support level in the downward trend. So we are having our penny bar highlighted in the green box. So we have our support level. We are seeing that after the penny bar hitting the support level, the prices are rejected, and such a penny bar is called a bullish penny bar. We are seeing that after hitting the support level, we are seeing the market trending upwards. It means that at that time the buyers are the one in control of the market. So if the formation of this candlestick occurs near a resistance level, it indicates that the buyers reject the prices and prevent the bulls from breaking this level. Now, when a penny bar forms in the resistance level in the uptrend, it is a clear indication that the buyers or sellers are going to take control of the market, whereby the prices are going to be rejected by the resistance level and prevent the bulls from breaking that resistance level. So this means that the sellers are willing to push the market downwards, and this is illustrated in this illustration that you are observing right now. We are seeing our resistance level, so we are saying that at this level the market was trending up, but after hitting resistance levels the prices were rejected, and now we are seeing a downward trend, and at that point it is the sellers taking control of the market, and such a candlestick is called a bearish penny bar candlestick. So if you understand the physiology behind this price action pattern formation, it is a clear indication that you will be able to predict what is likely to happen in the future, and you will make good trades based on high profitability penny bar signals. So now, how can we trade the penny bar candlestick with the trending market or with the trend? Of course, we have seen the physiology behind their formation, especially when after hitting the levels we have the support and the resistance levels, and those are the major turning points where the prices are rejected. So here we are going to see how to trade the penny bars with the trend. And if you are a beginner, you have to stick with the trend, because the penny bars that occur in the trending markets offer good trading opportunities with high risk to reward ratio. When you master trading it with the trend, you can then move to the trade range bound markets or even the counter trending markets. This strategy is very simple. You can start by identifying a clear uptrend or a downward trend, and then you wait for the penny bar to occur after a pullback to support or resistance level. You can see in the illustration below. So we have our resistance level, we have a penny bar forming, and we're seeing a pullback. So we are seeing a pullback made here, and after a pullback we are seeing a retracement move, and after a retracement move we are seeing a longer tail on the penny bar. It indicates a retracement move, and after forming a penny bar, it hits the resistance level as you are observing in the box that is highlighted in the green color, and at that point we are seeing that the market is reversing. So if we have our resistance level and the market is trending after a retracement move or a pullback, we are seeing our market reversing due to formation of our bearish penny bar at the resistance level. So after forming a penny bar at the resistance level in the uptrend, so we are seeing that the selling power is becoming more powerful than the buying power. So such a figure shows us a price action signal that works if it is traded with a trend, and you can see the price was rejected from the resistance level, which indicates that the bears are still in charge of the downward trend. The formation of a penny bar indicates the end of the retracement move, and this is the retracement move after a pullback from the resistance level. So the formation of that penny bar indicates the end of a retracement move, and it is now the sellers gaining control of the market. And after the formation of such a penny bar, it is a clear indication that we are going to have a new impulsive move at the resistance level with a line going downwards, meaning that the market has reversed, forming a downward trend market. And it is a high quality setup because all the following criteria are respected. So when you try to observe such an illustration, we are seeing that the criteria that I'm showing you or going to show you is going to be respected in case you observe that illustration. The first is that the penny bar is well formed. As you are seeing, our penny bar, it is well formed and it is in line with the direction of the market. The rejection occurred in a major key level which represents a hot point in the market or the resistance level. So we are saying that from the illustration, the following is observed. And the third thing is that the risk to reward ratio is good and it is worth trading. Sometimes, even if the market is trending, we can't draw the support and resistance level because the prices move in a certain way which we can't spot statistic key levels, and such levels are what we call the support and the resistance level. I think that in some cases, even if the market is trending, at some point we can't locate the support and resistance level due to the fact that the prices move in a way that we cannot spot such levels. and this can be observed in the illustration below. So we have our downtrend market as you are seeing it. We have our penny bar that has formed, but that penny bar is in line with the downtrend, and we have our trend line. So, and we have our resistance level that is marked with the line in the red color. So from the chart you can see that the market was trending down. So using the 21 moving averages has to help us to identify the dynamic resistance levels and the high profitability penny bar setups. That is what we call the 21 moving average acts. So it has to act as our resistance levels, so that we can identify a penny bar candle in the trend. Of course, this is a downward trend, and this happens in case we can not identify the support and the resistance level in a market trend. Therefore, we use the moving averages to identify the penny bar candlesticks. So you can also observe the illustration. This is a trending market. The first one was a downward trend, and this is an uptrend market, and we are seeing that the moving averages are going to help us identify the penny bar candlestick signal. But this happens in case, or this is done in case we cannot identify the support and the resistance levels in a market trend. We use the moving averages to locate the penny bars, especially when they form in a market. So it is a 4-hour chart above, and it is illustrating how the 21 moving averages cloud helped us to find the key points in the market, and those are the turning points or the resistance and the support levels. So moving averages help us to identify penny bars depending on a market trend. It may be an uptrend or a downward trend, and when the prices approach the moving averages, the buying pressure takes place in the market and the prices go up. So the penny bar signal is clear on the chart because the trend is bullish. As you can observe, the trend is bullish, meaning that the buyers are the one in control of the market. So the price action setup has a bullish atom as well, and the rejection from the 21 moving averages is a confirmation signal to buy the market if you depend on this trend. So the importance of the moving averages, they just help us to identify penny bars, especially when it comes to a point where we cannot identify the support and the resistance level. Yes, this is enough for today, and in the next video we shall be looking at what we call the trading tactics. It has very many factors, therefore just be prepared and stay fit. Just subscribe to the YouTube channel, especially for those who are new, and it is also important to turn on the notification bell, and this will enable you get notified in case I drop a new video here. I just want to thank you for watching. Stay connected, watch the previous videos for you to understand each and everything.